Welcome to Illuminati Silver. We tell you the truth about silver. Today is Wednesday, the 12th of June, 2019, and we are highlighting another sign of a global economic slowdown: oil. During the past few months, we've produced a number of YouTube videos highlighting signs of a global economic slowdown. These have ranged from central bank reports to China and Europe's lower GDP figures, India and Turkey losing preferential tariff import status, poor vehicle sales, and a host of other examples. An area we have also touched on recently has been oil production and demand. And it is to this area we are returning because the concerns we previously expressed seem to be coming to fruition. It is reported by Reuters today, quote, "World oil markets have undergone a U-turn, switching from supply-side risks like OPEC's production cuts or US sanctions against producers Iran and Venezuela," analysts said, to concerns of slowing consumption amid fears of a global recession. As a result, crude oil prices have turned a 45% price rally in the first 4 months of the year into a slump of more than 15% since late April. US investment bank Goldman Sachs said today that weakening economic growth and lower oil demand expectations were the largest driver of the move lower over the past months in crude oil prices. And with the outlook dim amid trade disputes, especially the one that has led to an expanding exchange of tariffs between China and the United States, analysts have revised down their oil demand growth forecasts, unquote. Examples of this are energy consultancy FGE have this week revised their global oil demand forecast down from 1.3 million barrels a day to 1 million barrels. Barclays Bank have also said this week that it has revised down its economic growth outlook for the United States, China, India and Brazil, and global oil demand also down to 1 million barrels a day. And we are all only too well aware that combined these countries represent 3/4 of global oil demand growth. Research firm T.S. Lombard likewise forecasts similar in GDP terms and are concerned that an unresolved Sino-American trade war, quote, has the potential to trigger a recession in 2020, if not before, unquote. Now, China's May crude oil imports fell by 8% from April to 9.47 million barrels per day, while car sales fell in May to 1.91 million, down 16.4% from a year earlier, marking an 11th consecutive month of decline in the world's largest vehicle market. Only yesterday it was reported that a dramatic fall in car production and an easing of stockpiling by manufacturers meant that the British economy contracted 0.4% from the month before, meaning that growth for the 3 months to April slowed to 0.3%. Though having said that, it has been reported today that wage growth beat market and economist expectations, with salaries rising by 3.4% compared with a year ago. After taking inflation into account, wage growth was 1.4%. Also, the UK unemployment rate remained at 3.8%, and has not been lower since the October to December 1974 period, so it's not all bad news. What is noticeable here, however, is that whilst unemployment levels in the UK and US are at relatively low levels, they are considerably high in Europe, with Spain at 14.1%, Italy at 10.5%, France at 8.8%, and the euro area as a whole at 7.8%. Global growth appears to be declining, and unemployment holding relatively firm for now, but this could indeed change overnight. The non-farm payrolls last Friday, with 75,000 new jobs announced compared with a forecast of 180,000, may either be an aberration or a sign of diminishing growth. Next month's figures will indeed reveal more. So, with oil demand down, growth figures forecasted to be lower and jobs growth slowing, there is indeed something to be concerned over. Of course, central banks and governments can introduce financial measures to spur growth and move to lower interest rates, and in some cases, such as China for example, currency devaluation. But this is a trend we need to watch closely, not panic over, but watch with a critical eye. Meanwhile, gold is recovering slightly at $1,335, only $5 below its Friday's close, and silver stands at $14.81, some 21 cents below its Friday's close. Earlier this week, both were considerably lower. But do notice the gold to silver ratio has now passed 90-1, as we predicted. Certainly not madness. In fact, it's standing at 90.15-1. And we are expecting to see a gold to silver ratio of 91-1 quite soon. So, what are your thoughts? Are we going to see a recession this year or next? If at all, do share your views. We hope you have found this video interesting and informative. And if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.